So good morning for the audience in Japan and good evening for those in the US. Welcome to the special webinar titled US-Japan Economic Relations under the New Leaders, sponsored by Tokyo College, and also the Center on Japanese Economy and Business, or CJEB, at Columbia University. And this is Takeo Hoshi, director of the Tokyo College, and I will be moderating today's webinar with Professor Takatoshi Ito, together with Professor Takatoshi Ito, professor at CJEB, also a former visiting professor at Tokyo College, I should say, and also my co-author of the Japanese economy textbook from MIT Press. The webinar is in English, but comes with a simultaneous translation into Japanese, as other Tokyo College webinars are. So if you want to listen to the simultaneous translation in Japanese, please select Japanese or Nihongo by clicking interpreter or tsuyaku button in your webinar application. Since we have many CJEB audience today, and they may not be, they may not know what Tokyo College is, and they may not have attended Tokyo College events before, let me start by saying a few words on the Tokyo College. So Tokyo College is an organization within the University of Tokyo and was created in February of 2019, so exactly 6 years ago. And Tokyo College, the purpose of the Tokyo College is generating new knowledge to contribute to the creation of an inclusive society and sparking deeper public engagement. And we have the slogan, shaping a shared future together. And under this slogan, we have been inviting distinguished scholars and intellectuals from all over the world, but especially from the US and Japan, and featuring them as speakers in webinars, just like we are doing today. So, but before I introduce today's speakers, since today's webinar is also co-sponsored by CJEB, let me ask Taka Ito to introduce CJEB to the frequent participants to Tokyo College webinars. Taka?
Thank you, Takeo. I'm Takatoshi Ito, Director of the Program on Public Pension and Sovereign Funds at the Center on Japanese Economy and Business, or CJEB, at Columbia Business School. I'm also a professor at the School of International and Public Affairs, or SIPA, at Columbia University. For those who don't know, CJEB was established in 1986, and the center's mission is to promote knowledge and understanding of Japanese economy and its business systems in an international context. CJEB is the only research center focusing on the Japanese economy and its business system within the university setting in North America. So that makes us very special. I want to take a moment to thank CJEB's corporate and individual sponsors for their generous donations, which allow us to contribute developing and delivering exceptional programming like this. So now I'd like to return it to Takeo.
Okay, thank you, Taka. And I'd like to thank the corporate and individual sponsors of the Tokyo College to allow us to deliver a program like this. So now let me introduce today's speakers very briefly. Professor David Weinstein is the director of CJEB, my counterpart, and he's also Carl S. Shoup Professor of the Japanese Economy at Columbia University. And he's a world-leading economist in the areas of international economics, corporate finance, and of course, the Japanese economy. We also have Professor Keiko Ito from Chiba University. She is also a well-known economist who does research on international economics, especially on multinational corporations and supply chains. And finally, we have Professor Yasuyuki Todo at Waseda University. He's also an expert on international trade and investment, and has numerous research on trade and supply chain issues. So we are focusing today on trade issues, especially those between the US and Japan. So we have an ideal panel of experts on international trade, especially the US-Japan trade issues. So we have ideal panel members today. So now let's start the panel discussion. And just to give a background, today we want to discuss the US-Japan economic relations, and we especially focus on the issues of tariffs that President Trump has been talking about and is imposing on imports from many countries. And we also want to figure out, so we first want to figure out what these are, what President Trump or Trump administration is up to, and what are their implications, especially for Japanese government and corporations. So President Trump often said that the tariff is the most beautiful word in the dictionary to him, and threatened to impose high tariffs on basically all the imports. Earlier this month, President Trump announced 25% tariffs on all imports from Canada and Mexico, and 10% additional tariffs on all imports from China. Canada and Mexico announced they would retaliate with tariffs on goods produced in the US. And after talking with Prime Minister Trudeau and President Sheinbaum, President Trump decided to postpone the introduction of tariffs on Canada and Mexico by 30 days in return for the commitments by Canada and Mexico to boost border enforcement. China also announced they would retaliate, but a talk between President Trump and President Xi has not happened, as I understand it. And the US started imposing 10% tariffs on imports from China, and China has retaliated by imposing 10 to 15% tariffs on selected goods from the US, including crude oil and LNG, liquefied natural gas. And US President Trump also announced 25% tariffs on steel and aluminum from all countries. And also he's been talking about reciprocal tariffs on all the trading partners. And maybe someone can, in the panelists, can tell me what reciprocal tariffs mean. And in the meantime, for Japan, Japan's Prime Minister Ishiba met with President Trump last week. They confirmed close ties between US and Japan and talked about the coming golden era of US-Japan relations. So the meeting seems to have gone very well. Trump said the Nippon Steel would not be allowed to own the US Steel, but they can invest. But Trump did not rule out the possibility of imposing tariffs on imports from Japan, as many other trading partners, saying the US trade deficit in Japan is too large. Ishiba promised to boost Japan's investment into the US, and Japan will expand its imports of LNGs from the US. So these are the background as far as I understand about the tariff issues related to US-Japan economic relations. So given these backgrounds, I invite the panelists to give their views on what's happening now and where we are going from here. I'll start with David, and then I will ask Keiko, and then Yasu. Please try to limit your initial remark to no more than 10 minutes so that we can do some discussion later on. And also, we want to take some questions from the audience as well. So let's start with David. I understand you have some slides to share.
Give me 1 second. We will
Okay.
get that. And hold on 1 second. Is this working? Are you seeing my slides?
Yes, this looks good. So
Perfect.
please go ahead, Dave.
Okay, great. So I want to just start at a fairly high level, just to kind of give you an understanding of what has been changing. So I think the election of President Trump marked the end of what a historian, Gary Gersel, calls the neoliberal order. So we've kind of seen around three different orders in the post-war period. And kind of one way of thinking about what an order is it's when you have a bipartisan belief in a set of policy norms. So, for example, from the end of the Second World War to roughly 1980, that is the time of the election of people like Thatcher and Reagan, US politics were largely governed by a New Deal order in which we had a lot of government intervention in the economy and also the development of a lot of international regulatory institutions. So in terms of US, you had a very strong union movement. You had fairly activist fiscal and monetary policies. Japan too also had a lot of government intervention in their economy over that time period, and we see the creation of the IMF, the World Trade Organization, et cetera. Starting with the 1980s, we see a big shift in politics, certainly US politics, in which we had the creation of a new neoliberal order in which politicians tended to push heavily for deregulation. And in the US, you saw that happening with politicians like Reagan, but also Democrats like Clinton also pushed forward a lot of telecom deregulation, et cetera. Similarly, in Japan, you saw a lot of deregulation of financial markets, especially in the 1980s, deregulation of also we saw the Big Bang reforms under Hashimoto, et cetera, et cetera. For reasons that we can discuss perhaps later, this order broke down with the election of President Trump, as well as other populist leaders, who basically have push back against rules-based systems, and we've seen a much more transactional approach to international relations, countries not following World Trade Organization guidelines, but also having a lot of skepticism to international institutions. And so this is a fundamentally different way about thinking about things. But one thing I want to stress is this is not just Republicans who are believing this. We see similar patterns in Democrats, although the reasons why they want to violate international rules often differ. And one example of this end of the neoliberal order is the US-China trade war that initially erupted in 2018, 2019, continued basically unabated for the last few years, and then seems to be escalating again now that President Trump has been reelected, and it featured some very high tariffs on a substantial fraction of US imports, and then also retaliation by China. One of the things that we're also seeing, and this makes it so confusing to study what's going on, is that there has been a strategy that sometimes is called flooding the zone, in which there is just an enormous number of policies or policy announcements is a better way of saying it, that create confusion and make careful analysis or reasoned response impossible. I'm just going to give you on the slide the set of tariff policies that have been announced over the last 2 weeks. And you can just see, without me running through, is that there have been a lot of different threats of policies. There was a January 31st, there were the Canada-Mexico tariffs that were announced, the 10% tariffs on China. Markets began to fall on that day. over the weekend, Canada and Mexico announced retaliation. Futures markets fell another 1.8%, following about a 0.8% fall on January 31. Then suddenly on the following Monday, February 3rd, the trade war with Canada and Mexico was delayed with some minor concessions by both countries. China retaliated on February 4th. We've had the 25% tariffs on steel and aluminum. And then also on February 10th, we had the US proposal about reciprocal tariffs, which, as far as we can tell, basically involve US imposing the same tariffs on foreign countries that foreign countries will impose on the United States. Now, again, I want to emphasize that it's very difficult to do careful analysis because of the levels of policy uncertainty. Policies that are announced are often not implemented or suspended. And this makes it very difficult to understand what is going on. And so it's hard for me at this point, just given the fact that policies change almost on a daily basis, to give you a clear vision about what the future looks like. I actually don't think the administration really knows what the future looks like. And part of the reason for that is they often seem to be backing down in when there are adverse market reactions to the policies, or if they face serious retaliation. What I do want to stress is that this is a big change. So I'm showing you a plot of what's happened to average import tariffs in the United States over around a 25-year period. And you can see that tariffs were coming down with WTO liberalizations. And then basically with the US-China trade war, average tariffs shot back up. So basically reversing about 25 years worth of liberalization. The other thing that I want to stress is that markets have been surprisingly, or maybe not so surprisingly, volatile in response to these tariffs. This is a slide in which I document what I call log RMT. This variable over here is just the log of the market return on the days in which the US and China announced policies. And you can see that pretty consistently on each of these tariff announcements, the markets fell on average around 1 percentage point. And it's very consistent. It's not one drop. Overall falling around 12 percentage points over the course of these 11 policy announcements. These are huge drops. This is a drop in terms of monetary value of around $4 trillion US, suggesting that markets really did not respond well to the escalation of the trade war. In our estimates, we think that this uncertainty and tariff increases associated with these drops probably lowered US welfare by around 3 percentage points, which is far bigger than what you might have suspected with conventional analysis. And one major reason for the difference between our estimates and others is that we build in that greater uncertainty that's happening as a result of the tariffs. I'm running short on time, so I'm going to actually just skip a few things and just jump straight to the steel tariffs before I finish. The steel tariffs have a long history in the United States. So this is a plot just showing you what fraction of imports from China and the world have been covered by steel tariffs. You can see in recent years, substantially all Chinese imports have been covered. And this is, again, both Democrats and Republicans have been involved in this. Interestingly, at this point, a lot of US steel is not really from China or even Japan. It's mostly the EU, Canada, and Brazil. And those are the countries that are going to get hit hardest by these tariffs. One thing that's very clear in the data is that U.S. steel production is not due, U.S. employment in steel is not due, the drop in U.S. employment in steel is not due to um, uh, 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 foreign import competition. This is a plot showing in red what has happened to steel output over the last 35 years. That's been fairly constant. The line in blue is showing employment in steel over the last 35 years. That's been falling sharply. How can it be that employment is falling when output is not? The answer is technology. We're just becoming more efficient at producing steel with fewer workers. And so this notion that it's foreign competition that's killing off our employment is overly simple. A major force is just technology. Just to, in the interest of time, I don't want to go over very much. There's very little evidence that protection increases employment in the United States, and a major reason why that doesn't happen is that when you raise the price of steel, you get offshoring. Users of steel start doing assembly abroad. So that they can exploit cheaper foreign steel, and it doesn't produce a lot of benefits for U.S. Producers. I'm going to skip this. The last thing that we also see is that the U.S.-China trade war has caused a major shift in imports. Economists like to have trade based on cost advantages. Trade is increasingly based on circumventing tariffs, and Mexico and Vietnam in particular have been big beneficiaries of the U.S. Trade policy. So let me just finish up by simply saying that we're seeing that import prices are rising as a result of this. We're seeing a lot of negative impacts on U.S. industries, that we're not seeing jobs being created. We're seeing prices going up. We're seeing stock prices going down. And we're seeing a shift in patterns of decoupling, at least between the U.S. and China. And we're seeing really a collapse in the global trading regime, at least as far as the United States is concerned. But that said, I think we're seeing other trading relationships strengthen, and this, of course, is very worrisome from the standpoint of the U.S. So I'll stop here.
Okay, thank you very much, David. And next up is Keiko. So you have slides too, right? So while Keiko is preparing the slides, as we said in the chat, for the audience, you can write in your questions using the Q&A function of the Zoom, and I will be watching Q&A and select some of them to share during the panel discussion. So Keiko, please go ahead.
Can you see my slides?
Yes, I
Yes.
can see your slides. So
yeah.
this looks good.
Hello, good morning from Tokyo. I'm Keiko Ito from Chiba University. Thank you very much for inviting me to this webinar and giving me a chance to discuss the US-Japan economic relations. Okay. Yeah. So first, of course, the US tariff measures are undesirable, but I think that the direct impact on Japan may be limited. So the negative impact of tariff measures may not be non-negligible in some sectors, for example, the automobile sector. However, exports from Japan will not be significantly reduced if the price elasticity of Japan's exports is relatively small. And moreover, even though Japanese exporters lowered the export price, or even though Japanese exports was reduced, the quantity of Japanese exports was reduced because of the US tariff measures, Japanese exporters can secure their revenue and profits in Japanese yen if the yen remains weak. So, no, of course, we had better avoid US tariff measures, but the magnitude could be limited. So, I believe the coming 4 years of the Trump administration would be a time of patience for Japan. So my main message today is be patient. And now it is crucial for Japan to invest in improving our own technological capabilities with a focus on the post-Trump era. Okay, so first, let me start with introducing the simulation results recently released by 2 Japanese research institutes. They estimate the impact of Trump tariffs on the Japanese economy. In fact, these 2 research institutes produce quite different simulation results. So first, on the right-hand side, the Daiwa Institute of Research estimate the Trump tariffs impacts, and their estimate says that the Trump tariffs will lead to a decline in domestic demand and production in Mexico, Canada, and the United States. The tariff measures will accelerate the inflation in the US, leading to reduction in the US demand. And the reduction in the US demand will have a negative impact on Japan's exports. So overall, Japan's real GDP could decline by up to 1.4%. However, on the left-hand side, the Institute of Developing Economies estimates that the US tariff measures could have slightly positive impacts on Japan's GDP. The IDE estimates show that the impact on the automobile industry in Mexico and Canada will be significantly negative, but the Japanese automobile industry is likely to receive a positive impact partly because exports from Mexico and Canada to the US will replace exports from Japan to the US to some extent. So in short, it is difficult to predict the impact of the US tariff measures on the Japanese economy. And the magnitude of the impact depends on factors such as the extent of the trade diversion effect and how much the price increase due to tariffs reduces US demand. So moreover, the economic activity is now highly complex. So this figure shows the breakdown of the revenue of Japanese transport equipment firms. The top bar shows the total revenue of firms located in Japan, and exports account for approximately 40% of the total revenue, and about 1/3 of the Japan's exports go to North America. So North America is definitely a very important destination of Japanese automobile exports. And the figure also shows that Japanese transport equipment firms have expanded into the United States, Mexico, and Canada, and the revenue of their affiliates in North America is now 2.5 times the exports from Japan. So if the United States imposed 25% tariffs on imports from Canada and Mexico, the Japanese automobile firms in Mexico and Canada might face significant revenue and profit losses, potentially needing to shift production to the United States. But if the United States impose tariffs on imports from Japan, the tariff measure would negatively affect automobile exports from Japan to the United States. However, we should note that the 89% of exports from Japan to North America are directed to related parties. So in other words, they are intra-farm trade. So in the case of intra-farm trade, price elasticity may not be very large. So if so, even though the United States imposed tariffs on imports from Japan, Japan's automobile exports to the United States may not be affected so much. And furthermore, the Japanese yen and the US dollar exchange rates also significantly affect Japan's exports and Japanese exporters' profits in terms of yen. So if the yen remains weak, exporters can secure their profits to some extent. So recently Prime Minister Ishiba has pledged to boost Japan's investments in the United States to $1 trillion US. So that will put upward pressure on the US dollar. And moreover, Trump tariffs are likely to accelerate US inflation, so which leads to higher US interest rates and further upward pressure on the US dollar. So it is expected that the yen will remain weak and the dollar will stay strong for the time being. So that means Japanese exporters can secure their profits in yen, even though they lower the export price to some extent. So in addition, some previous studies show that Japanese exporters tend to choose US dollar invoicing and maintain the initially set prices and do not frequently revise the price in US dollar. Moreover, even though export prices change, export quantities do not change much. So that means the price elasticity of Japanese exports is not so large. So based on these previous findings, I would say that the US tariff measures will not significantly reduce exports from Japan to the United States, particularly export value in terms of yen will not be reduced much as long as the Japanese yen remains weak. So this figure shows the share of currency in Japan's trade. As you can see, 87% of Japan's exports to the United States are transacted in US dollar. So that means Japanese exporters have been making significantly large profits in terms of yen in recent years because of the very weak yen. So here again, the left figure shows the trend of Japan's exports to the United States, both in terms of US dollar and in terms of Japanese yen. And the export value in US dollar is much smaller than the export value in Japanese yen. So there's a huge gap. And the right-hand side figure shows the sum of operating profits of major Japanese automobile manufacturers. So we see that Japanese automakers make significantly large profits in yen because of the weak yen. So if the weak yen continues for some time, Japanese exporters may not have to overly fear the impact of US tariff measures. So the biggest negative impact of the US tariff measures will likely be on US wholesalers, retailers, and consumers, I think. Yes, so far, I am relatively optimistic about the impact of US tariff measures on the Japanese economy. However, of course, we had better avoid US tariff measures. So if US tariff measures lead to a reduction in world trade and a slowdown in global economy, they could have a significant negative impact on the Japanese economy as well. But I believe we shouldn't be swayed by the US trade policy. So this is a time of patience for Japan. And now is time to invest in strengthening Japan's own technological capabilities. So in fact, Japan's domestic investment has stagnated for 3 decades. The prolonged stagnation of investment has led to a relative decline in Japan's technological capabilities. So, now as US-China tensions intensify, so Japan needs to explore new R&D partners and new markets. To achieve this, Japan should make active investments to enhance its own technological capabilities. So the figure shows the trend of tangible and intangible assets intensity for Japan, the United States, and Germany. So the figure indicates that Japan's investment in intangible assets, the red line, have seriously stagnated. And Japan's investment has stagnated all 3 types of intangible assets, namely software and databases, and innovative property, and economic competencies. So the figure indicates that Japan should reflect on its failure to invest in R&D, human capital, and organizational capital for the past 3 decades. And also, this figure shows the rate of return for Japan's outward FDI and inward FDI. The figure shows that the red line, the rate of return of the inward direct investment, is as high as the outward FDI rate of return, the blue line. So that means foreign firms investing in Japan obtain relatively high profits. So that suggests that Japanese firms should be able to make high return investments domestically. So there should be some good investment opportunities in Japan. On the other hand, investing in the United States is fine, and it could be seen as one of the strategies for responding to Trump tariffs. However, I think that we should be smart enough, so it is still important to evaluate the profitability of FDI in the US, and FDI in the US should be aimed at technology sourcing. So finally, I point out that it is important to expand and deepen cooperation with Southeast Asia and the Global South countries. So, China's presence in the region has been expanding, but Japan remains the most trusted major power among people in Southeast Asia. So Japan must maintain technological superiority and strengthen the economic and political ties with Southeast Asia and the Global South countries, keeping an eye on the US-China tech rivalry. Okay, so in sum, US tariff measures may have non-negligible negative impacts on Japanese affiliates in Mexico and Canada, but the overall impact on Japan's exports would not be very large, I think. And if the yen remains weak, exporters can secure their profits to some extent. So now Japan should focus more on domestic investment and improving technological capabilities. So that's my main message. Well, I prepared our slides on the Japan steel production exports, but because of time limitation, I will skip this slide now, and I may go back to this slide later if we have time to discuss. Okay, so thank you very much.
Okay, thank you, Keiko. Now, Yasu, you have 10 minutes, and you have your slides as well, right?
So my name is Yasuhito from Waseda University. First of all, I'd like to thank Professors Hoshi and Takaito for inviting me to this webinar. And also, I'd like to thank Tokyo College and the Columbia Business School for organizing this webinar. And I'd like to talk about how we can make win-win Japan-US relationships, assuming that we cannot actually change President Trump's policies. And let me start with looking at the recent trend in foreign direct investment from Japan to the US, as this is a hot issue now. So this figure shows the so this figure shows the total FDI in all sectors from Japan to selected countries. FDI from Japan to the US has increased substantially during the Biden administration. Total FDI actually increased almost threefold for the recent 4 years. And during the first Trump administration from 2017 to 2020, FDI from Japan to the US was actually stagnant. But now we shouldn't shrink this increasing trend under the second Trump administration, as Prime Minister Ishida emphasized in the Japan-US summit last week, and also Professor Ito, Keiko Ito emphasized right now. And in this figure, you can also see that FDI from Japan to China actually declined for the recent 2 years, and FDI to ASEAN is slightly increasing, but not much. And this figure is focusing on FDI in the automotive industry. We actually don't see an increasing trend in Japanese FDI to the US recently. But because high tariffs may be imposed on imports from Mexico, Japanese automakers will have to invest in the US more in the future. And this move has started already as Prime Minister Ishida announced new investments by Toyota and Isuzu at the Japan-US summit last week. And therefore, we would expect that the protectionism policies by the second Trump administration are most likely to increase FDI from Japan to the US. This may be unfavorable to the Japanese economy and companies, because FDI forced by President Trump may result in efficiency loss. However, I'd like to note that the Japanese auto companies' FDI to Mexico has not been that large as this figure shows. So still, the negative effect of tariffs on Mexican exports can be limited. And moreover, I like to argue that there are two ways to take advantage of this situation and turn it to a win-win situation for both countries, Japan and the US. First, FDI from Japan to the US should be associated with knowledge links, such as research collaboration, so that both countries can learn from each other and facilitate innovation. Second, as the US-China decoupling is strengthened, both Japan and the US need to expand supply chains to other countries. One way is, of course, to mutually expand supply chains between the two countries, but still we need to expand the supply chains to the global south for economic profits and resilience. So I would like to explain the details one by one. First, expansion knowledge links between the two countries. So this figure shows the international research collaboration can improve the quality of innovation at the firm level. And the effect of international research collaboration is much, much larger than the effect of domestic collaboration for any country, including Japan and the US. So this is most likely because through international research collaboration, we can learn new knowledge from foreign partners. Therefore, we would expect that, however, unfortunately, Japan has not been actively engaged in international research collaboration. This left figure shows that Japan is the worst two in terms of the share of international co-invention among major countries. So the lack of international research collaboration, knowledge linkages may have been a major cause of economic stagnation of Japan for several decades. So therefore, Japan needs to be changed. In fact, the situation is changing actually now to the direction favorable to Japan. The US-China decoupling is reducing research collaboration between the two countries, as this figure shows. So as we saw earlier, even the US has benefited from international collaboration. So now the US is looking for new research partners for innovation. So definitely Japan, the third largest country in terms of patent grants, the number of patent grants can be a candidate. And actually, I'm very happy to see that recently research collaboration between Japan and the US, particularly in the semiconductor industry, are quite active, supported by the Japanese government's industrial policy. So these two notable cases where Japanese companies like Tokyo Electron and Rapidus are collaborating with US and other foreign companies like IBM. And these cases are promising to create a win-win situation for Japan and the US. And this win-win situation can be strengthened further if Japan's FDI is associated with the joint R&D in the US so that the two countries can learn new knowledge from each other. So in fact, the joint statement of the Japan-US summit last week mentions the need for joint research in frontier industries like semiconductors, AI, and quantum computing. So I expect such joint research will be actually strengthened. So second, we look at supply chains. So this figure shows the imports of electric and electronic equipment to Japan and the US, the left Japan, the right the US, from selected countries in the region. So here we are representing supply chains of critical products. So you can see that the share of China is in the US imports is declining rapidly. And imports from Mexico are kind of stable, but may decline from now due to possible tariffs. However, imports from other regions such as ASEAN have been stagnant. So increasing domestic production by onshoring may not be able to cover all the reduction in imports from China. So therefore, the US needs supply chain partners alternative to China. And the major candidate is the Global South countries, including ASEAN, India, and Africa. And looking at the left figure, the share of imports from China to Japan has not been declining much. So, however, there's a risk of a disruption of imports from China due to national security concerns. And my simulation actually found that found a huge negative effect of a disruption of imports from China on the Japanese economy. So to avoid this, Japan should reduce the reliance on China and diversify supply chain partners. However, like the US, Japan's imports from ASEAN and other Global South countries is not increasing much. So supply chains of Japan and the US are not diversified to the Global South enough because of several obstacles. One is that Japan and the US are not providing economic benefits to the Global South compared with China. So for example, China's Belt and Road Initiative provided infrastructure and promoted trade and FDI from China, as this figure shows. So therefore, Japan and the US should cooperate and provide infrastructure and technical assistance to the Global South. And another obstacle is the differences in approaches to human rights, labor, and the environmental issues between the Western countries and the Global South. So the Western countries often impose strict regulations in terms of these issues on supply chain partners, including those in the Global South. So such regulations reduce trade and investment between the Western countries and the Global South. So for example, this figure shows the negative correlation between the difference in the democracy level between two countries and their trade value. So I would suggest more realistic approach to the differences in these issues, not imposing too strict regulations and allowing for gradual improvements in the Global South. In this regard, I actually expect that the Trump administration is more flexible to these issues. So let me summarize and propose some suggestions. So Japan can avoid possible negative impacts of policies by President Trump by investing more in the US and promoting research collaboration with the US. And in both cases, costly search for good partners is a major obstacle. So policy support to information collection, networking, and business matching should be expanded more. And Japan and the US should expand supply chains to the Global South through developing infrastructure and being flexible to human rights and environmental issues. Preferably, I would expect Japan and the US create some kind of a new framework to state this flexibility explicitly, for example, using free and open Indo-Pacific. So tariff issues still remain, of course. But anyway, we need to try to avoid the negative impacts of protectionism policies as much as possible by, for example, implementing these policies and to achieve a win-win relationship between Japan and the US. Thank you very much.
Thank you, Yasu, and thank you all the panelists for informative remarks. Let me ask some questions to the panelists before I take up some questions from the audience. And Taka, you may want to join. Well, you're welcome to join whenever you want. First question from me is this is mainly for David. As you have pointed out, the tariffs. Tariffs are usually considered to be not very effective or not very welfare enhancing for the country by economists. And also, as you mentioned, the tariffs during the first presidency of Trump were overall bad for the U.S. The importers and consumers lost through higher prices, and the benefits of protecting U.S. jobs was minimal at best. So my question is, why then is the Trump administration is eager to impose tariffs this time again?
Yeah, that's a great question. So I think the first thing I want to kind of stress is there's been this general breakdown in the neoliberal order, the idea that we had a rules-based system, and to some extent that started from the left. When people began to protest the WTO and began to feel that we should be using tariffs to achieve other objectives. And so let me give a few examples. Increasingly, there was a lot of talk in the US of using tariffs to enforce labor standards, using tariffs to enforce environmental standards, using tariffs to generate regime shift. So the level of sanctions over the last 50 years has been rising dramatically. So when you don't like what another government is doing, you want to impose tariffs. So that was kind of one trend that was important on the left. I think the left was not particularly sensitive to the idea that, let's say if you think about child labor, that most countries when they're poor US included, Japan included, had a lot of child labor. It's not clear that that would have been solved by imposing tariffs on them and punishing them for that. There are other issues going on. Trump, what we've seen, and this is what makes it difficult to analyze from a standard economic lens, is motivated by things that are not related to what economists would call welfare, which is per capita income. So, for example, the Canada and Mexico tariffs, right, made little economic sense, but he was motivated about Mexico, motivated for imposing the tariffs on Mexico due to undocumented immigrants coming into the U.S. From Mexico. Fentanyl was a big issue in both Canada and Mexican tariffs. One can argue about, in fact, I think there's not a lot of evidence that tariffs produced more than cosmetic effects on these countries' policies. But what we're seeing is that the economics that we usually apply to tariffs isn't what's motivating it. This other stuff, the fentanyl or whatever. And so I think that's a big change that's happening. I mean, indeed, sorry, just to add one last thing, the current tariff levels were set in the U.S. Canada, U.S. Mexico Canada trade agreement, and that was generated by Trump. So he's kind of setting the rules and then breaking the rules, and this makes it very hard to negotiate.
Okay, thank you, David. So we need to go beyond the simple-minded economic analysis to understand what's going on. Yasu, you want to jump in?
Yeah, actually, I still think economics are behind the Trump's policies because obviously the middle class in the U.S. Suffers from globalization. So David mentioned the research by Professor Ota, but he actually found that Chinese imports from China actually reduced employment in the U.S. So also, if I can, I want to share this figure showing the so it's in Japanese. I'm sorry, but it's a median income of the U.S. So it's been stagnant after 2000, the participation of the China in the WTO. And so this is obviously an economic reason why the U.S. citizens, voted for President Trump. So I'm actually happy to see that the median income is now increasing. So the situation may change, but still, I want to emphasize that we cannot ignore this economic issue. Thank you.
Okay, we certainly don't want to ignore economic issues, but I guess there are some non-economic issues we want to focus on too. David.
If I can just say, so I certainly don't think we should ignore economic issues. Indeed, I think part of the collapse of the neoliberal order has to do with the global financial crisis in 2008, and exactly as Toto Sensei was saying, that on the left created the Occupy Wall Street movement, that created on the right kind of the Tea Party opposition that became the Trump base. And so I think exactly as that figure suggests, there became a movement in the United States that felt that elites or the institutions that were promoting free trade were not benefiting the average worker. And so, I think David Otter's done some great work showing, and his co-authors showing that exactly as you said, the imports from China seem to be associated with employment losses. But he also has data saying that when you impose tariffs on China, you don't get those jobs back. And I think this is kind of an issue that's out there. And economics tells us that we should compensate the losers, that trade is good because the winners can compensate the losers. But what's been happening is when there are losers, they're not getting compensated. And so that is, I mean, I agree completely with what Professor Toto is saying, is that that is motivating a lot of this anti-globalization sentiment on both sides.
Okay. Thank you. Let me take some questions from the audience because there are several great questions. So the first one I want to take is this one from the audience. Prime Minister Ishiba has announced that he will increase investment in the US to 1 trillion yen. And Yasu seems to support this policy of increasing investment into the US, while Keiko seems to be emphasizing the significance of investment within Japan, the domestic investment in the assets, human capital, and other intangibles, including. So what is important? More important, investment abroad into the U.S. or investment in Japan? How would David or Taka respond?
Taka, do you want to go first, or?
Okay. So I think that going to the US is classic tariff jumping. So they build up the tariff wall, then you want to be inside. So if some Japanese industries who have some money to invest and who are exports are prevented by the tariffs, they are motivated to invest in the US, and probably steel, automobiles, especially those who have been exporting from Mexico, they have incentives to invest in the US. I think that Keiko's point is coming from different, but she can explain herself, but I'm also thinking that domestic investment is important because I think the Japanese companies have been they're investing abroad and moving those key design R&D parts to the foreign countries. And I think the Japanese-based factories are losing the productivity edge. So the Japanese wage stagnation up to last year are partly due to the productivity stagnation in Japan. And I think it's about time that everything is, relatively cheap in Japan. The Japanese companies have incentive to invest in Japan. Also, not US, but I think that China, when there's a US-China conflict and also security issues comes in, then you want to pull out of China and invest in Japan. So there are two different motivations. One go to US, one go inside Japan. Thank you.
David?
Sure. So I agree with everything Taka just said, and I think there will be a tendency for that investment to go up. I also think Japan's been pretty masterful in terms of how they've been handling President Trump. Certainly avoiding a lot of tariffs during the first administration, and coming off very conciliatory in the latest meeting, and which I think was a success. One thing that is very important to keep in mind is that governments' statements about how much they will increase investment and what actually happens to investment are two very, very different things. We saw in the first trade war with China, the Chinese made all sorts of commitments to increase US imports. And these were touted in the media, but then if you look a year later at what actually happened to US imports, not very much happened. And in some sense, I think this is cheap talk to say we're going to increase investment by this amount. It certainly, but it's very successful in managing the president, I think, because it gives him a chance of saying we've had a victory. I would be surprised if we actually see the level of investment exceed what we've had before, after controlling for exactly the kinds of forces that Taka's talking about. So it'll naturally go up, but it may not be because of Japanese policy.
Okay, Keiko, do you want to add something?
Okay, thank you. So, well, I think it's okay to increase investments in the United States, but it's it's up to the private company's decision. So private companies should evaluate the rate of return of the investment, and then if it's sufficiently profitable, I think it's okay to invest in the United States. But the Prime Minister Ishiba, he promised to increase investments in the United States. But after he came back from the Washington, D.C. to Tokyo, he also said that it's a private company's decision. So, the government cannot force the private firms to increase the investment to the $1 trillion US. So just, what I want to say is that if the private firms see that the investment in the United States is profitable enough, then, it's okay to promote investment. So, they need to, very precise evaluation whether it's profitable or not. Okay, thank you. Yeah, that's my opinion.
Thank you. Today we have an unusual number of good questions from the audience, so I apologize, I can't get to all the questions. And in fact, the next one will be the last question we can take. So let's take this one. Yeah, so very, very quickly, yes.
Yeah, so I just want to emphasize that I'm not saying we don't need a domestic investment, but actually investment in intangible asset is very important, which is actually written in my textbook. And also I want to emphasize that that's a private decision, but still, we need a policy. Policy can encourage investment. So that's why I emphasize the importance of policies to support the networking and business matching and so forth. Also, the government should clarify the uncertainty in the policy. Relationship between with the U.S. so that then private companies are more willing to invest in the U.S. Thank you.
Okay, thank you. So let's take one last question. To counter pressures from President Trump, who basically wants to cut bilateral country-by-country deals, could CPTPP members, this is a comprehensive and progressive agreement for Trans-Pacific Partnership, could CPTPP member countries unite as a group? Who wants to take up this question? David?
Okay, sure. Yeah, I think that's likely what's going to happen. I mean, I think the U.S. is pulling back from its role as a global leader. I think there's no question that that's happening. I think there's no question that trust for the United States is falling, as we saw earlier in the presentation. And what is naturally going to happen is that the EU is going to form its group, and I wouldn't be surprised to see if many countries in Asia pull together. I think also a potential major winner from this is China. Although China has its own set of problems which may interfere with that. But my sense is that this is going to be very damaging for U.S. relations with much of Asia.
Yeah, thanks, David. It's ironic that U.S. was leading the effort for TPP, as late as 10 years ago.
Yeah.
Okay.
So similarly, not just as CPTPP, but WTO could be reformed without US if the Europe and Japan, Asia can get together and just write same articles and instate appellate body and go without US. That's possible. And Paris Agreement will go without US. So all those global international orders may be reformed and US will be isolated.
And JICA can fill in for USAID.
Yeah.
Okay. So thank you all for a very active discussion. I'm sorry we are running out of time. There are still lots of good questions from audience as well. But Taka, do you want to make a closing remark?
Thank you very much. Thank you everyone joining us. And I want to give special thanks to David, Keiko, and Yasu for their insightful contributions to today's discussion. And thank you to our organizers, Tokyo College at University of Tokyo and Center on Japanese Economy and Business at Columbia. I'd also like to express CJEB's gratitude to its corporate and individual sponsors. And lastly, that we'd like to announce, we would like to advertise another webinar a week from today on the US-Japan political relations, not economic, but political relations under the new leaders with Gerald Curtis, Mireya Solis, and Kazuto Suzuki. So make sure that you check on the website of CJEB and Tokyo College. Thank you very much. And see you next week.
Yes, so we will see many of the audience next week again on the political relation between US and Japan. Thank you very much.